Good morning, grade 12s. Today we are going to continue with inventory valuation. We are looking at the periodic inventory systems. You'll remember there's three different ones, and the first one that we are doing today is called FIFO. FIFO stands for first in, first out, and this means that the stock that was bought first will be the stock that you sell first. So the stock that you have on hand at the end of the year will be the stock that you bought the most recently. This system is used to value the goods with a short shelf life. Okay, so goods that are perishable or not durable, less durable, so that the stock that we bought first, obviously we need to clear off the shelves first before it loses value, as it will lose value very quickly. In this system, proper packaging and display is obviously very, very important. When you buy new stock, the old stock should be moved forward on the shelf so that the older stock is on the front of the shelf for consumers to take first, and the newer stock will be placed behind that at the back. This relies on the prudence concept. Because we are valuing stock at the year end, we are valuing basically the stock at the most recent market prices. So it is a more realistic idea. It gives us a more realistic idea about what our stock is actually worth. Okay, if we look through the first example, LG TVs in Krugersdorp sells TVs and TV accessories. The purchases and sales for the month of April is shown below. The business uses the FIFO method of stock valuation. Okay, so the transactions during April. Okay, you'll see here that there was an opening stock of 6 units. The cost of those units from the last year was 1,000. So 6 times 1,000 gives us the 6,000. During the month of April, there was 2 purchases. On the 5th of April, we purchased 12 units on credit, and we paid 1,250 per unit, which means 12 times 1,250 gives us a total value of 15,000. Then on the 17th of April, we bought a further 15 units on credit, this time 1,500 Rand per unit. So the total value of that would be 22,500 Rand. The total purchases for April, in other words, is the 12 plus the 15, which is 27. And the 15,000 plus the 22,500 makes up the 37,500. Then they give us information that on the 24th of April, there was 2 returns. So 2 of the items that we have purchased, we returned back to the supplier. And the cost price of these was 1,250. So you have to be able to notice that these 2 returns was from the purchases that was made on the 5th of April, because the cost price was the same. Okay, the total value of the returned items was 2,500 Rand. Then they tell us that the sales of the month was 18 units, okay, so 18 television sets. We sold them for 2,700 a unit, which means our total sales, our turnover basically was 48,600. We are now expected to calculate the closing stock. Okay, what is the closing stock? Now, when we do this, you need to remember the opening stock of 6. This would be the items that is sold first. So the first 6 customers that comes in to buy a television set, they will be buying this 6. After that, the next thing that will go is going to be the 12 units that we purchased on the 5th of April. Just keeping in mind that we don't have 12 to sell because we sent 2 back. We returned 2, so this basically would only be 10 that we have available to sell. That would be the second group of TVs that we would sell. And then if we obviously sell more stuff, the last sales for the month would come from the last 15 that we had bought. Okay, so the first thing that we are going to be required to do was to calculate the stock on hand at the end of the month. Okay, so in other words, how many television sets, how many units do we have left? Okay, and then we also have to calculate the value of the closing stock, okay, in monetary terms. Okay, now the way that we do this, we're going to make use of the FIFO method. Obviously, we said we are going to sell these 6 units first. All right, remember now we said that there was 18 units sold for the month. Okay, so we're going to see what we have available for sale. That would be the opening stock of 6, the purchases that we made on the 5th of April, which was the 12. then the 15 that we purchased on the 17th of April, but remember we also returned 2 items. So what we have available for sale during this month is 31 units, and then they told us that we have sold 18. Okay, so we have to sell 18. With FIFO, obviously we sell the opening stock first in, first out. So this 6 television sets would be the first 6 that we have sold. Okay, then 18 minus 6 is 12, so we've got 12 to go still. Okay, now just remember, we said that these 2 returns came from the purchases that was made on the 5th of April. So this, we don't have 10 available, we don't have 12 available to sell. We actually only have 10 of these available to sell. So that would be the next 10 television sets that we are selling, is the 10 that we bought on the 5th of April. Altogether, this gives us 16. So we know that of the last stock that we purchased, of that 15, we have sold 2. And the 10 and the 6 and the 2 is going to give you the 18. So we know, okay, we have done all the sales. So basically what we have on hand, okay, 6 minus 6 is nothing. So there's none of that on hand still. The 10 that was left there minus the 10, there's nothing on hand there. But of this 15, we only sold 2. So we would have 13 items on hand still. All right, so there was 31 goods that was available for sale, but we sold 18 units. That means that there should be 13 items on hand, okay, as we saw there. All right, but what is the value of the closing stock? It is the 13 that we have left, but now we need to know what is the unit price. And you'll remember that the stuff that we purchased on the 17th of April, we paid 1,500 Rand per unit. So 13 times by 1.5 a unit means that the value of the stock in our store at the moment, the stock on hand, is 19,500. Okay, if we look at the second example, this one is a bit more involved. Okay, this is the case of Packer's Suitcase Shop. Okay, Charles Packer sells travel suitcases. The year end of this business is the 30th of June 2020. The stock balances, okay, his opening stock was 420 units, okay, travel suitcases, at a unit price of 2,175. So 420 times the unit price means that the total value of his stock at the beginning of the year was 913,500. The closing stock, we are told that there's 496 units, but obviously now we have to work out what is the value of that closing stock. Okay, the purchases, returns, and the carriage for the year. Okay, during the year there was a total of 3,155 purchases. Of that, in September, we purchased 850 at a unit price of 2,250, which 850 times 2250 is going to give us this amount. In December, we bought another 980 units at a unit price of 2,670, which means the total value of it is this amount. Then in March, we purchased another 875 units at a unit price of 2,930. And if we add that up, that is going to give us this amount. In June, we purchased another 450 items at a unit price of 3,040, which adds up to this amount. If we add all of these together, all the purchases together, the total purchases for the month adds up to this amount, and a total units of 3,155. But then they give us more information. There was returns from the June purchases. Okay, so these 25 items was returned after we bought them, but they have to come from the June. Okay, it was of the June stock that we have purchased. So the unit price is 3,040, and the total value of our returns will be that much. Right, then the last information they give us is our sales for the year. We sold 3,050 suitcases, and we sold them at 4,200 Rand each. Okay, 4,200 Rand each. So obviously to get the total sales, we would take the 3,050 suitcases, multiply by 4,200. Okay, so when we have to calculate now the value of the closing stock, an easier way of doing this, instead of saying, okay, counting, this is how much we sold of the opening balance, and this is how much we sold of the stock that we bought in September and October and November, we are going to make use of the bottoms up approach. Okay, so we're going to start at the bottom with the closing stock in step 1. And we are told that the closing stock is 496 units. So we have to figure out which purchases, the purchases on which date does this closing stock, where is it coming from? Okay, when did we purchase this closing stock? So remember we said the closing stock, obviously with FIFO, the stuff that we purchased first would be sold first. So the closing stock would come from the most recent purchases. We need to see how much of it, how much of each purchase date. Okay, so in step 2, we are going to take the purchases less returns for June. Okay, remember in June there was 450 units purchased, but of the 450, 25 units was returned. So in this closing stock, okay, in this closing stock of 496, we know that all of the stock, all of the purchases that we bought in June, that 425, that is still part of this closing stock. All right, and then we still have to see instead how much of the purchases that we made in March is going to be left over in this closing stock. Now, how much of the stuff that we purchased in March is still left over stock on hand at the end of the year? All right. So if you take obviously this 425 plus the 71, that is going to give you 496. So bottoms up, we are taking the 496 minus 425 and then minus 71 to get to 0. Okay, you are trying to get to 0 so that you can see where the closing stock is coming from. Right, so we are making use then of the bottom-up approach. Okay, so for the purchases of March, we said that in March, the stuff that we purchased in March, 71 of it is now on hand still. Okay, we've got 71 of it left still, and the unit price of that was 2,930. That means that the value of this 71 units is 208,030. Then we know all the purchases in June, that 425 that we purchased in June, all of that is still left, and the unit price of that was 3,040. So if we calculate that, 1,292,000. When we add the two together, that is going to give us the value of our closing stock. Okay, the units left is 496, but we have to calculate the value of the closing stock in monetary terms. Right, so 71 of it, the unit cost was 2,930, and for 425 of them, the unit cost was 3,040. So in total, there is the value of our closing stock. Then, the second thing that they expect from us is to calculate the cost of sales. Okay, there's your formula. Okay, you have to know your formula, obviously, to do this. You're going to start with the opening stock, the monetary value of our opening stock, which was 913,500. We take the net purchases, okay, which remember is our total purchases minus the returns. Okay, that is going to give us 8384,850. We minus the closing stock, okay, that was calculated on the previous slide. Okay, so opening stock plus the net purchases minus the closing stock that you had to calculate. And that is going to give you 7798320. Okay, next thing that we have to do is to calculate the gross profit. We have our sales. Sales was given. We were told that 3,050 units were sold at a selling price of 4,200. So if we calculate that, it gives us our total sales. Then we minus the cost of sales that we calculated on the previous slide. It was 1,500,30. That means our gross profit that is left is 5,011,680. Okay, then the next question is going to say, Charles suspects that suitcases have been stolen. You have to provide a calculation to support his concern. Now for this, you are always going to use the units and not the amounts, okay? Because he wants to know how many suitcases have been stolen. Right, so his opening stock was 420. That was given to us. Okay, we add the purchases, but remember in units now, not in amounts. Then we're going to minus the returns, minus the closing stock, okay, which we calculated. And that means that the goods that are available for sale that we should have is 3,054. Okay, we minus the sales in units. and that means that the number of items that was stolen is 4 items. Okay, so your opening stock plus the purchases minus the returns minus your closing stock at the end of the year. Okay, that meant that this was how much we would have had available for sale. We have only sold this much, which means that there's 4 items that is unaccounted for. Okay, this is just an alternative method of calculating the amount of items stolen. Instead of using that calculation, you can also use a T account. Right, on the T account, your number of items lost. On the debit side, we're going to have the opening stock, which was 420. We add the net purchases. Remember, your net purchases is your purchases minus your returns, okay, which was 3,130 units. Okay, this is still in units. On the credit side, we're going to put that we have sold 3,050 of them. The closing stock was 496. So your missing item will be your balancing amount. Okay, just again, remember your net purchases will be the purchases minus your returns. Okay, then Charles is also concerned about the volume of stock on hand. Calculate how long his closing stock is expected to last. All right, so obviously we're going to look now at the stock holding period. Okay, the first way of doing this is you're going to take your closing stock times the 365 days over the cost of sales, and that is going to give you an amount of 70.2 days. Or you're going to take the units on hand times 12. Okay, in this case, the units over the cost of sales of the units. Okay, and that is going to give you 1.92 months. Remember, if we want the answer in days, we're going to multiply by 365. If we want the answer in months, we're going to times by 12. Okay, stock holding period. Okay, then the last question is going to say, Charles is concerned about the volume of stock on hand. State one problem with keeping too much stock on hand and one problem with keeping insufficient stock on hand. All right, if you have too much stock on hand, what is your possible problems? Okay, first of all, your goods can become obsolete, okay, out of fashion, and then it will be useless to customers. Nobody's going to want to buy it, and you are going to be stuck with the stock. You are not going to be able to sell it. The staff also may notice that there's less movement in stock, so they're going to notice that the stuff is there in the storeroom, it's there on the shelves, it's not moving, and that might be tempting for them. They might try to steal it, okay, because they're seeing that it's not going anywhere, it's just sitting there. So that might be tempting for them. If there's insufficient stock on hand, so not enough stock on hand, what is your possible problems? Okay, the business obviously will not be able to meet the demands of your customers. Okay, if you don't have stock in your shop and people come in and they want to buy a suitcase and they realize that you don't have any suitcases in stock, they are not going to come back. Okay, if you tell them no, they must just come back in a month's time, they want the suitcase right now. So they're going to leave your shop and they're going to rather buy somewhere else. And then you have lost a paying customer. Okay, they're never going to come back and they're going to tell all their friends not to come to your store because you don't have stock for people to buy. Okay, now I want you to practice. You're going to do task 10.8 on page 374, and I think you need to now switch to the paper 2 answer book. Okay, you just look in your books, but I think inventory is in your paper 2 answer book. So we're going to switch the answer books. Okay, so do task 10.8, it's on page 374 in the textbook. This is your homework, and then on Monday we're going to mark task 10.8, and then we're going to do the next stock evaluation system. Okay, the next one is weighted average. I think we're going to look at the weighted average method on Monday.